Good morning, everybody. It is July the 29th. Can't believe it's already almost done with summer. My kids are going back to school next week, so very excited to have the Monachino dynamic duo here today as our guests. So really, really long overdue, I would say, with Monachino Partners, the experts in all things mergers and acquisitions. So thank you very much. I would say we have known each other just long before me. I've been at CMS for 15 years, and I know Joe, you especially have known CMS for how many years now, you think?
Over 20,
Over
25.
20 years. So very, very much appreciate you joining us today. And every time I speak to you both, I definitely learned more and more. And Colby has a very exciting time coming up here in the next month, getting married, and um, also just finished a marathon. So he's a little crazy to me that he's such a little runner and very impressive at the same time. So as people are coming in, just want to remind you that what I would prefer you to do is use the Q&A feature at the bottom per usual and avoid the chat. So if you have any questions, I can kind of monitor them and keep track and I'll check them off. And we will, unless it's super urgent, I will monitor those towards the end of the webinar. And without further ado, Colby and Joe, please take it over.
Thank you.
Thanks, Jackie. I'll go ahead and share my screen here. Joe, let me know if we're
Yep, looks good.
okay. Perfect. Well, thanks everyone for joining this morning. Thank you, CMS, for hosting us. We've been looking forward to this. We're Monachino Partners. Give a little bit of an overview on us. We specialize in offering full service brokerage and consulting services tailored to companies in the security, fire, life safety, and integration sectors. I'm Colby Monachino. I'm the co-founder and chief operating officer. I oversee all of our day-to-day operations, M&A initiatives, and Joe and I work collectively to help our clients and companies successfully buy, sell, and grow. Prior to this, I worked under Joe at a company he co-founded, originally called Alarm Funding Associates, which rebranded to Alarm Connections, and I managed the central United States for that company. So oversaw a portfolio. It was around $670,000 of RMR. Position there was 50% alarm dealer management, 50% growth, and help manage our internal operating teams within the territory. So I covered Ohio, where I'm from currently, all the way down to Texas, and then spread out west. And that company merged with Alert 360 a few years back, and we're working through that transition. That's how Monachino Partners was born. So I'll let Joe introduce himself here as well.
Right. Well, thank you, Colby. Yeah, I've been in the business over 45 years, which is kind of surprising. But started all the way back with Security Link with Russ McDonnell, and evolved through several different operating and acquisition companies. And back in 2005, co-founded a company called Alarm Funding Associates. And as Colby said, we rebranded to Alarm Connections. We were an acquisition company. We were fairly unique in the business in the sense that we were more a source of liquidity for independent alarm companies. We would acquire a portion of their recurring revenue or all, and they would remain in business, maintain their brand, and it was unique in the sense that we were able to align the customer experience with Alarm Connections, as well as our national partners across the country. Highly successful venture, and went from zero to about $4 million of monthly recurring revenue from starting in 2005 through late 2023-24. So that kind of gives you the 30,000 foot perspective on my experience.
Great. So just a little bit of an overview on what we'll go over today. We'll give you an overview of our services we offer at Monachino Partners. Go over a high level overview of two of the most common industry valuation approaches. Joe will dive into key factors of buying and selling. So how do you get to those values and the different approaches you'll take. Some best practices we've learned through our experience in the brokerage consulting space as well as the acquisition space. Talk about some of the key partners we align ourselves with, and then happy to take questions at the end. So as I said, Monachino Partners, we're a full service brokerage and consulting firm. On the M&A front, we represent companies that are both looking to sell and looking to acquire. We work hands-on with our clients. We can be as hands-on as they would like us to be. For companies that are looking to sell, we work with them ahead of time, helping them prepare to go to market, bring them up to speed on different valuation approaches, educating them on the process, the due diligence process, and then ultimately working with them to put together a confidential information memorandum or a SIM. It's a Bible on the company. It tells its story so that when you're ready to go to market, acquirers have all the information they need to evaluate the opportunity on their end. So comprehensive, but detailed oriented, helps create value for sellers. On the buy side, we work with companies that are looking to acquire. We help them identify opportunities in target markets and portfolios. And then ultimately with our background as well, once that is identified, we can work with them and manage due diligence process as well. So working through the sale process, helping them qualify accounts in a portfolio in a company, and then ultimately we can also help with post-acquisition integration work too. We'll mention some of our partners at the end, but we've aligned ourselves with partners within the financing space. We, Monachino Partners, don't provide financing, but we have key partners that do. And can help connect and align companies with financing groups, those looking for capital. If you're looking to get into the growth space, we can be helpful on that front, as well as working through succession plans, so ownership transfers, partner buyouts. We have companies within our network that specialize in those kind of opportunities as well. On the consulting front, business valuation, we do a lot of work with companies that say, hey, I'm not ready to sell right now, but 1 or 2 years out. We'll work on putting together a fair market analysis on the company, give you a read on where value might stand today, areas to clean up. And then we also have companies that are saying, hey, not looking to sell, have 10 or so years, but I'm interested in where my company stands at the moment. So we put together a comprehensive analysis. So it's a fair market analysis that has good detail to back it up and gives you a good read on current value of your company. If you're working through a transaction, you don't necessarily need a broker to quarterback everything, but you're either planning to or working through a due diligence, and you say, hey, I need some help with this. Joe and I have been brought in to manage due diligence just on a consulting basis as well. Acquisitions, post-closing, and integration. I mentioned this, it ties in a little bit to brokerage, but if you're working through or you're just closing an acquisition, there's a whole second chunk of that you need to work through integrating into your portfolio. So we can help with billing conversion, customer communication, central stations themselves are already very helpful, can be very helpful with this, but we can advise on that process if there's a conversion, as well as helping, identify, where some key members of your team can be helpful, integrating accounts and data into your network. So industry valuations, I'll give you an overview on, the two different approaches we're seeing most commonly: RMR, recurring monthly revenue valuations, or EBITDA, earnings before interest, taxes, depreciation, or amortization approaches. So the first is RMR. I think this is probably the most traditional, most common historically you've heard of. These prioritize the value of predictable contract-based monthly revenue streams, typically applied when companies have high percentages of monitored accounts or recurring service agreements. So ideal for alarm monitoring companies, residentially, focused or heavy companies, businesses with high RMR concentration, and then also companies or individuals just looking to sell accounts or account sales. Those are typically going to see more RMR approaches taken. A little bit of a range here, but valuations we typically see range from 30 to 40 times RMR, and that's net of pass-throughs. So that's deducting your costs for interactive services. So if you have $20,000 of RMR, $2,000 of pass-throughs, that's your Alarm.com, your Alula. The multiple is going to be applied to the $18,000 of RMR. And why the range? There's a lot that factors into it. So, health of the account, size of the portfolio, geography, attrition, all play a role into where value will land. Joe and I have seen lower than 30 and higher than 40 as well. So really comes down to the evaluation, but you're going to see premiums typically placed on companies that have strong average revenue per user, or ARPU, low attrition, and long-term and solid contracts. We'll touch on this a little bit later, but a key term you'll probably hear, terms you'll probably hear us reference is margin and cash flow. So things are priced efficiently, good margin, buyers love that. So the other approach, EBITDA valuations, these typically reflect the company's overall profitability and operational efficiency, applied to companies with diversified revenue streams. So ideal for security integrators, commercial fire companies, businesses with significant project-based revenue. Similar to RMR, ranges, Joe and I, on deals we've done, see typically 5 to 9 times EBITDA. We've seen lower with smaller portfolios, and we've seen higher than 9 with larger portfolios. But again, just dependent on overall company size, growth rates, sales pipeline, customer concentration, attrition, market positioning, and then also, any type of succession planning for the business, with good employees, ready to take that next step with a good transition plan. Some trends, we're seeing between the two, I would say, is, there's definitely continued interest from buyers in high growth segments like commercial systems, video surveillance, and integration. I would say we're in a dynamic but increasingly selective market. I think you're seeing buyers buyers become more disciplined, placing a higher priority on due diligence to qualify their purchases. But there's a buyer out there for everybody. I think RMR buyers remain active, and well capitalized. We have a number of groups within our network that are looking to acquire residential portfolios. And between the two value ranges we showed you, I mean, the market has matured. I think we're seeing wider spreads in valuation. But regardless of your portfolio or portfolio breakout, premiums are reserved for companies that are well prepared and well positioned to go to market. So, for Joe and I specifically, when we work with companies, those looking to sell or those looking to acquire, we break out everything. We do an RMR breakout by type. We calculate EBITDA or net income, depending if it's a cash business or not. And we really break down what value method works for you and your company. Or if you're buying, what's the best approach to take here for you as the acquirer, looking to put an offer in. So on either end, you're either coming to market knowledgeable on the approach we'll take that'll have the best value for you, or as a buyer, the best value to approach putting in an offer. So tying it back, we work hands-on, we break everything out. Joe.
Yep. So we're going to talk about 8 critical factors to consider whether you're buying or selling. So we can go to the next slide, Colby. So first of all, just understanding is, and we do this with our sellers, and we're requested to do it by anybody we represent on the buying side as well. So being able to really break out your residential, commercial fire, whether it's video surveillance, access, video monitoring, any integrated service that's under contract and recurring revenue. Those elements are important to be clearly defined, both on the P&L, what the revenue is that's coming from each of those segments, but a buyer specifically would want to know exactly, the residential accounts, how many customers, number of line items or services, and that would hold true for both a commercial customer, commercial fire customer, anything that's contracted for video monitoring or access, or any other integrated service, or for anything that's contracted for service maintenance contracts. So the one thing you have to be able to be prepared to do when you're selling is be able to break out all of those elements of your recurring revenue, because they're going to be driving down in diligence on the specifics and especially the gross margins on all those services, because that's what the total, that's part of the valuation, is really looking at what are the drivers, what are the levers, and what kind of cash contribution are those services bringing down to the bottom line. So that's all critical, and that's part of what Colby was talking about, is when we prepare a seller, we actually drill down on those kinds of metrics, so we have a full understanding of the revenue contribution from each of the services that they're billing. That also holds true for installation revenues, service revenues, any gross revenue product as a result of new sales, product sales, box sales, whatever it is that's driving your top line revenue, all has to be broken out and looked at in terms of the revenue contribution to the bottom line. Attrition rates are critical. So when we work with a seller, and buyers specifically as well, they're going to want to look at an RMR roll forward and attrition report for at least 2.5, 3 years. So if you were looking to sell your company today, they'd be looking at 2023, 2024, and year to date. And CMS can provide add delete reports, but we will actually work with the seller to show them what their actual gross attrition rates are. Gross is still gross. That means how many customers you lose each month. Ads are ads, but the way that the industry looks at attrition is they look at your beginning RMR, they look at the gross attrition number, and they divide that number by the top line number to get a percentage on a monthly basis. So the lower the attrition rate, the higher the valuation, because that shows the stickiness of the customer. It also shows that you're doing service well and that you have a good customer experience. They also really kind of look at, especially whether it's commercial or residential, but they do look at, what's it cost to create a new customer? Is it a positive gross margin? Is it a negative margin? So, they're really, a buyer is going to try to look at your current growth engine and how that would translate to them as the buyer if they wanted to continue to drive the business that you're currently driving with your business. So again, that's another factor that drives valuation for prospective buyer. We can go on to the next one, Kobe. How you grow is important too. So it's kind of like what your internal growth rate is. How are you organically growing the business? And in terms of, again, buyers are looking at several aspects of your gross revenues. Clearly, the recurring side of that equation, new installations and service. Service has a tendency to have higher margins on it, whether it's contracted or time and material service. But each of those elements of your gross revenue are going to be looked at. The other side of it is if you're growing on a recurring basis, regardless of the service, are you offsetting and growing? Are you first offsetting attrition, and are you growing? So you may be mitigating attrition through new growth, but you may not be offsetting attrition through new growth. So if you're not offsetting what you currently have, then the valuation of the portfolio will not be as great as companies that are driving new growth. They call it CAGR, but through new business, new sales, and new recurring revenue customers. Income and profit. Bottom line performance is critical. And it's critical even whether or not it's an RMR sale or a multiple of EBITDA or net income. And when we use that word EBITDA, that's earnings before interest, tax, depreciation, and amortization, by the way. Most companies, and maybe most of the people on this call, are doing a P&L on a cash basis. So that would really look at your net operating income as the bottom line. So all of the factors that drive your net income is really driving your profitability. And obviously, the higher the income percentage to your gross revenues, the higher the valuation is for a company that's going to be acquiring. In terms of adjustments to EBITDA, we also look at that. So if you're selling the company, there are going to be aspects of what you're expensing in your business, some of which is going to be personal. I mean, we've seen all kinds of things. So they may have personal medical expenses that they expense that the company pays for. They may have two cars that are not, quote, company vehicles, but are treated as such. There may be advertising, or there may be other things like dues and subscriptions that, when you sell your company, the company that's buying you doesn't need to, if they're an ESA member, you don't need to be an ESA member. So there's some adjustments, add backs to the net operating income that will increase the value at the bottom line, because they won't be spending the money that you're spending currently as the business owner. So all of this is very detailed, and that's what we do. I mean, a lot of what we try to accomplish on behalf of a seller and what we look for on behalf of a buyer are basically the same thing. So we will drill down with you on your P&Ls, your balance sheet, making sure that your income is gross income is properly managed against your general ledger. We'll look at direct margin costs on all aspects of the revenue that you're driving, whether it's installation, service, RMR, project-based, box sales. So we get a good flow of how the gross margins are driving through to the bottom line in your growth. These factors are critical to your business. And what we do find is a lot of times most companies are not ready to sell because they don't have all their ducks in an order, and they have to go in and actually clean how they're accounting for their revenue on the P&L, as well as making sure that they have itemization in the recurring side that can be broken out, so that we could do a margin analysis on each of the RMR components.
So best practices or lessons from the field, and these are, I think key takeaways Joe and I have found that increase value for you as a business owner, looking to sell or looking to acquire. So not areas of us telling you how to run your business, but areas we found that create most value. And I think a key point, I've heard it said before, but very important, operate today as if you're preparing to sell for tomorrow. Businesses that are well structured, efficient, and scalable, prepared if you're, on the sales side, attract premium valuations. And I think the same goes for acquirers, especially if you're, just looking to get into the acquisition market. Your current operation or platform, that needs to be running smoothly, well structured, efficient, to take on more headcount, to take on more customers, integrate billing systems, central station, et cetera, et cetera. So it works on both ends. Keeping financials and accounting clean, processes well documented. I think a main point we'll continue to touch on is, a well-prepared company not only improves profitability and not only increases value for the seller, but it reduces risk for buyers, which in turn creates more value for everybody. Maintaining key contacts and industry relationships. I think on two ends, this can be very helpful. Your vendor partners, central station, they will in some capacity, be involved in the sale process on either end. So maintaining good relationships there. They've worked through those processes with companies before, so they, can be very helpful on that front. Converting data. Industry relationships as well. This might seem obvious, but, mentors to me, working with Joe and, having worked through the acquisition process, in our previous life, is a lot of people have gone through it before. So they've either sold or they've either acquired. So even separate from a broker or professional representation, good industry relationships to seek advice on best approaches is always helpful. And I think, it just goes back to the point that buyers want to see stability. And that only helps that. Not all RMR is created equal. There's different types. Keep your customers contracted. We'll touch on this on a later point more specifically, but have good contracts. Joe and I can be helpful on this front, especially if, you're just working on evaluating your company or starting to prepare, but getting an understanding of, different revenue streams or RMR streams. They're valued differently, residential versus commercial or cloud-based system or cloud-based customers. They're all looked at a little bit differently based on their margin, how they're contracted, how they're invoiced. that all comes into play under the broad term of RMR. And then I think an important point that buyers drill down on goes back to margins and cash flow, but price strategically. And I think that it's a tough point, especially for owners that have owned companies for 30 or 40 years and have some really good long-term customers and maybe have not increased price in a while. We understand that's a tough line to cross, but at the end of the day, when companies being evaluated, good margin, good contracts always benefits the seller.
Right. So the other side of this, Colby touched on, is contracts. So you really need to have, if you, and I'm sure most of you do, have a contract for every customer. Again, part of our support when we work with a seller prior to selling their business is making sure they look at the fact that they can count the contracts. Hopefully they've scanned all the contracts front and back. You don't have to go through a file cabinet, and that they have a contract for every customer. Clearly, contracts, agreements with 36-month terms hold a stronger value, 36 or 60 months. Make sure that they have all of the legalese that's necessary to protect you and the future buyer, and that it has an assignment clause, that it can be assigned to a buyer. So again, strong contracts increase value. There's a number of contracts out there. There's a number of people who provide good agreements. If you have a company with agreements that date back, 15, 20 years, they may still be good, but they're an evergreen. So, you may want to, think through whether or not you recontract a lot of these customers in order to gain more value at the end on a sale. Refining your operations and billing systems goes back to what I was discussing before, when it came to the 8 critical factors for sale, and that's making sure that you have an automated billing system, that your records are correct, that detail on the RMR is itemized in the system, so that, as an example, we're looking at a company now, and they may have video monitoring, alarm intrusion monitoring, service contracts, and it's all right now boiled into one recurring number. Well, buyers are going to want to know what the specific item elements and recurring amounts are for each of those. And we would want to know, because we're going to do a margin analysis on that if we represent you. And if we don't, and the buyer is going to look at that as well. Also, in terms of standardization of operating processes, hopefully you all have good, solid accounting software, CRMs, anything that can automate a process for diligence, the better, because it's an easier transition to a sale. Most buyers, and when we do it as well, would want access to your accounting system to pull certain data. Of course, it's all under confidentiality, so and they already would give you an LOI. But on diligence, they're going to want to look into everything that they can possibly see to pull the data that they need in order to complete their field diligence. Avoid the manual and manual type systems. It's very hard to sell a company if you're writing it down on a ledger sheet. There's no automation, and it's a hard way to track historical numbers. And again, you can't wait for the last minute to do it. You have to kind of look at where you're at today and what would be the possible way to upgrade your systems and services. And in doing so, you're going to increase your efficiency, and the greater your efficiency in your operating systems, the better the customer experience is going to be as well. Diversifying revenue streams. Again, a balance between alarm monitoring, uh, commercial, commercial fire, residential. Um, Video monitoring is getting very hot these days in terms of prospective buyers looking into that market, um, as well as video services, hosted access, and so on. A lot of these, cloud-based services are attractive to buyers on the commercial integrated side of the business. And then your mix of RMR between service agreements and so on are again critical in terms of your diversity and scalability in the future.
And Joe, just going back quickly to the fifth point on not waiting to the last minute to change these areas we've seen, doing due diligence, working with companies to like Benchmark that go in and do a deep financial analysis is they like to look at customer payment history, and those trends. So if you change your accounting or your payment processor or billing systems a year before you sell, does it hang up the deal? No, but it makes tracking the historical data, uh, you know, a little bit more difficult. And what acquirers are also going to do is look to see that your billing and your billing customer data and your central station data match up and that they're aligned. So, having this stuff in place before only, reemphasizes that point.
Right, Kobe. And the other thing they'll do is if you're working off of net income or EBITDA multiple, they're going to go in, the buyer is going to go in and do a quality of earnings test. So it's the same process, making, having clean data in one operating system that can be pulled and verified and quantified is critical to evaluation.
So staying ahead of compliance and industry regulations, ensuring licenses, certificates, industry standards are up to date. I know a lot of companies are on top of this. I mean, a good plug for our industry associations like ESA, SIA, TMA. They're fantastic on the educational front on all of these and updates. Anything affecting local or state level or federal level changes that impact businesses that would potentially impact these. Those groups are great, but having those up to date will be key. They will be analyzed as well. I think something the last point, resolved legal, tax, financial, or licensing issues. I think that's something Joe and I see either hang up or kill a deal most frequently. Is especially on the debt side, buyers will go in and run a lien search on a company. And if you have a SBA loan for X amount of money, 95% of the time, depending on the type of sale, the debt's going to be required to be resolved at closing. So, just go from a sell side standpoint, going into that process, just having an understanding of what would need to be resolved at closing, not only helps you understand what you're probably going to net at the end of the day, but also it's just good to know what will need to be handled. And then on the buy side, acquirers that have been in the space a while, this is part of their due diligence process for all of them. If you're thinking of getting into the acquiring space, this is something important to add to the process, which is a lien search. When Joe and I represent buyers, we conduct this on behalf of them and preparing to sell. It's something we'll discuss with sellers. And if you don't have, a full read on what might come up, we can run that on your behalf as well. And a lot of times what we find too is it might not be an SBA loan for $400,000. It could also be something from 15 years ago from a lien that wasn't released. And no party knew. Sometimes happens with companies that were part of a dealer program or sold account. So an important part of the process. Good to get ahead of it before having to deal with it during due diligence. Planning your exit strategy. I think this ties back to our first point, but Joe and I, this is part of our process, helping dealers prepare to sell, but well thought out strategy maximizes your value at the end of the day. One of the first questions you'll get from a buyer, or we get from buyers when we're, initially speaking with them about an opportunity is, what happens when the owner or owners exit? How does the business run? Who do the customers call? And every business is different. But it's an important question to be able to answer. So having a well thought out transition plan, identifying key employees that might be able to take a step depending on the sale into that next role, either as a general manager, if it's going to be ran as a branch, or do you have some key people that can step into more high volume sales roles? Are there techs that can take that next step into becoming a lead tech? If it's a company that can sort of help acquire, that can help expand your services, are there technicians that can expand their licensing capabilities to do a little bit more? So, having a org structure and a plan for a buyer is key. Not to belabor the point because we've mentioned it a few times, but keep your financials transparent, primarily because you'll need to be able to justify them and justify the valuation, either during the initial search process or for sure doing due diligence. And then I think, an important part too on the preparation side is just get an understanding of the sale process, typically how long it might take, working with, a broker or a professional just to get an understanding of how value might play out for your company. And then also getting an understanding of all the different types of buyers in our marketplace. There's a ton. I think that, you definitely see, and they're great as well. But you see, some of the typical acquirers through, media outlets or LinkedIn that are active within the market. Again, they're great. But there's a lot of other buyers. There's strategic buyers, which are, established security companies, maybe looking to expand into new markets, but not necessarily national. Private equity groups that are either looking to get into the space or, looking to back companies that want to actively acquire. National buyers that have, a big footprint. Regional players that are, maybe in Ohio. They're based in Ohio, but they're looking to, they have branches in Pennsylvania, Tennessee, and West Virginia, actively looking to acquire in selective markets. And then search funds, which are, individuals backed by private equity groups, where they have equity commitment to acquire a company, go in and, retain typically the name and the staff and, run it from there. So there's more too. So, there's a lot of different types of buyers. So just working through that process and identifying, what's the best fit for me, maybe financially, but also what's the best cultural fit for my company long term, especially if employees are going to be retained and staying. So, be prepared, I think is a key lesson. And just to close on, Joe and I will, work. We have 2 acquisitions we're working on now. It goes back to a previous point of, what works best for value. We have one that's around $40,000 of RMR, 50-50 split. We broke out, it was, we ended up coming down to a net income figure, and then we broke out the RMR by segment and came to conclusion with the owners that, the RMR approach was better in terms of value. And we had, another company that was, more of an integrator, more services, but they had $60,000 of RMR. We did a similar breakout, and with them, we figured, all right, the EBITDA net income approach here is the better one to take. So, just going back to getting understanding of value and the approach is helpful in your preparation process. I'll touch on these briefly. But Joe and I, we're not attorneys, so we've aligned ourselves with a few key attorneys, specifically within the space as well. A group that's not on here, in addition to Dinsmore, Mitchell, Barlow, and Mansfield, is Mark Katz. His group is great. We've aligned ourselves with individuals like Wise Financial Consulting, Benchmark Performance Partners. They can be helpful if we're working through a larger sale, either in preparation or doing due diligence, to be helpful with financial modeling for banks. Joe and I do that. But when you're really diving into the weeds, they're a good second set of eyes to bring in to be helpful. Engage Communications, another great partner to CMS as well. Alarm Financial Services, Jim Wooster, and a few other groups we're able to reference or refer for financing as well. So, we align ourselves to try to be as helpful and resourceful to our partners or clients as we can.
Yeah, so many friends on this page, absolutely. So a couple questions real quick before we wrap up. But if you have any questions, please, like I said, refer to the Q&A and I'll definitely try and get those answered. But real quick, wanted just to ask with regards to who should be involved internally if I'm a seller, if I'm Jackie Security and I am, wanting to potentially sell my company, who in my team should be involved in preparation for a potential sale or a transition?
Yeah, that's a really good question. I think that so every business is different. Obviously, they're all ran and operated differently. So I think initially probably just the owners or owner, just starting to evaluate the process. During the data gathering, Joe and I do a lot of data gathering. We talk about this with our clients, typically involving, if they need help pulling some of the financial reports, some of the reports from Central Station. We've found that our clients might involve one key team member as we're doing the data gathering portion. And then, I would say after an offer is placed and signed, most buyers, like I mentioned earlier, do a deep dive into due diligence, which is probably going to require members of the team to help. So, at that point, after an LOI is signed, probably just strategically, having a conversation with your team, because a lot of times buyers are going to want to come and meet players as well. So I think to answer the question, just slowly accumulating maybe members of the team into the process. But again, every business is a little bit different and every owner is a little bit different with how they would want to approach it.
Okay. And then you mentioned, starting that plan of an exit strategy. What does that timeline look like? Like how soon should someone in their mind start initiating that timeline?
Yeah, Joe, feel free to jump in. But I think, I don't think that it's, even if you're not ready to sell, I don't think it's a bad idea to get a read on, where your businesses might be positioned and valued at. But it's hard to place a specific number on it, but I think, 2 years to a year and a half is a good time to start planning and just thinking about, what next steps might look like. If you feel like and Joe and I, as the other thing Joe and I do is we might get going in that process and someone says, hey, I have a year and a half or 2 years, and we start our work and we say, hey, maybe you need another year of billing under your belt. But I would say a year and a half to 2 years to start planning and talking with, a group like Joe and I is probably best.
Yeah. And we're working with a client right now in that situation where the company's evolved. It's a really quality company, but they've changed their method of operation and what they're selling. And they really need another year of proven performance to really increase their value, Jackie.
Right.
they're tracking exactly the way they should be tracking, but they need just another year, and then we're helping them clean up what they need to clean up. So all the things we talked about today are lined up when they're ready to go to sale.
Love you attendees because you're doing exactly how I asked. I love it. So I have a couple questions coming in. So one is, what do you view as an owner expense add back, and what is not considered an add back?
Good question. Anything that's personal to the owner that would not continue with the business. All right. So if someone were to acquire you, they're not going to have the burden of something that you're paying yourself for.
Okay.
So that's A. B, based on transition, even if you're getting a salary or it's a husband and wife or whatever, and you're pulling out, guaranteed payments, and you're pulling out a salary, what a buyer is going to look at is, again, what Colby said, what happens when Joe leaves the business? So there may be an opportunity to add back to the bottom line a portion of the income you're receiving from the business, but not all of it, because either they have to replace you or they're going to retain you.
Right.
So those are the kinds of things. If you own a building and they're not going to lease the building and they're not going to buy the building, then all the expenses for the building are not going to be there.
Right. Okay. Another question is, everyone seems to be looking for commercial acquisitions. So what is the market for a residential company currently today?
So yeah, I think going back to one of my initial points, that we have a number of groups within our network that are actively looking to acquire residential
So
portfolios.
contact Monachino Partners is what you're saying.
There's interest out there. I think that, yes, what you hear a lot is commercial, but and there's value there as well. I think that, it is the value the same as what it was 15 years ago. Not exactly, but valuations have changed just in general a little bit in terms of the approach. But there's interest out there for sure. And like I said in my previous point, valuation on that ranges. We're seeing 30 to 40 times. It's just dependent upon what it is you're selling in that arena.
And how would you say the landscape has changed in the last few years?
Joe, you can comment on that.
I mean, I think the landscape has changed from what we've presented, and part of the way the landscape has changed is how buyers are looking at the value of a company in terms of its, net operating cash flows. So, and again, everything we mentioned is what a buyer is looking at. They want scalable entity. They want a growth engine. If you have staff, that's critical. Everybody needs tax. And they're looking at efficiencies of scale, and they're looking at revenue contribution and growth. Because at some point, they're going to model out your company and project out what the new sales growth and operate and income's going to come to them. It has to be appreciative to them that it's accretive. Your business is going to be accretive to them and not a drag.
Another question that just came in, you mentioned having good margins. Can you share what is a good margin on video monitoring, or what someone can expect, or is that too broad of an answer to give?
That's too broad an answer.
Okay, I would think. So I know we're coming up on an hour here, and I appreciate you guys giving so much time, but as we wrap up, can you share any red flags?
Yeah, I would say, if you're committed going to the sale process, committed to doing so, I think that it's helpful to be prepared before, even entering it just to get a read on your value. You know, I think on the buy side, buyers like to see, you know, commitment from a seller to be able to pursue them. You know, from an evaluation standpoint, I guess a red flag evaluation standpoint, you know, do your due diligence, and sometimes those red flags will come up. But, you know, like I said, get an understanding of debt, get an understanding of, you know, how many customers are contracted or not contracted, get a keen understanding of the owners and their transition plans. A lot of times, you know, you don't want to really work with somebody, although it happens and that's fine. But, you know, there's transition that needs to take place. So, you know, you don't want to work with an owner that's committed during due diligence and then all of a sudden they exit stage left. So have holdbacks, you know, within your offer, so that, you know, owners are at least sort of, you know, tied to a transition for at least a year. So, you know, I think, you know, identify the red flags as a buyer by doing due diligence, and some of those will come up.
Okay. Very good.
Yeah.
Final call for questions as we wrap up. Anything coming into the chat, and then of course your contact information is listed here. Gentlemen, thank you so much for giving up an hour. Really, really do appreciate you sharing your information and knowledge with everybody. And of course, this is going to be recorded and we post it on our YouTube channel. So for anyone on this call that wants to reference back anything, as always, you can see it there in our library. So thank you. Oh, hold on. Just great session. Just a great, thank you so much for everybody joining today, and happy summer. Only a couple days left.